Let's get some more reaction. David Wolf joining us here in studio, portfolio manager at Fidelity Investments, also a former Bank of Canada advisor. So we got some additional commentary, David, nice to see you, by the way, from these bank officials on a day when nobody would have been surprised to see rates left unchanged. But I think people increasingly were very curious about the road ahead. Do you feel like we have a roadmap to work with here right now?
Well, I think they'll still be curious after what we heard today, and that includes what we got out of the inflation numbers in the United States. But I think the bank was as clear as it could be in terms of the road ahead, which is to say that they're seeing the kinds of things they need to see to be comfortable in cutting rates, but they're not seeing enough of them yet. And that's partly a degree thing, it's partly a time thing. But if things continue in terms of inflation and its drivers easing off the way it's been true for the last year or so, then rates cuts will be forthcoming. The other point maybe to make in there is the growth outlook itself, as has been talked about, has been revised upwards, which is in line with the recent data, and that's fine. But it's important to understand that that's not a particularly, optimistic, shall we say. I mean, it seems optimistic because, growth was weaker and now it's stronger, what have you. But the drivers there are population growth. And in fact, growth is undershooting the increase in people, which the bank didn't particularly highlight, but is clearly the case. Indirectly, it highlighted. But also the thing to think about is what has to be in the forecast for the economy to get stronger if population is going to be weaker and productivity doesn't move. And the answer is lower interest rates. So behind this forecast is a path of easing. We don't know exactly what it is, neither do they. But there clearly is, at least in their minds, some degree of a roadmap towards easier policy.
It also highlights there's just a lot going on right now, right? But and it is interesting that as much as people have found the population growth story a story with some short-term growing pains, as quickly as we put a couple of brakes on part of the plan, we're reminded that growth long-term is a big question for the Canadian economy. How would you compare the situation here in Canada versus the U.S.? Because, it's hard to ignore what's happening in the United States. We literally share the border. You hear about a resilient economy. You had hotter than expected inflation there today. But also, you had central bankers who felt comfortable enough to share some specifics on likely rate cuts this year. The Bank of Canada knows that their counterparts in the U.S. have done that. They're still not quite ready to do the same thing.
Yeah, so maybe a few points to mention here. First of all, there's kind of a public perception that the Bank of Canada can't move without the Fed, or certainly can't move in the opposite direction as the Fed. That's not the case. We've seen several instances over the past 10, 20 years where the bank was easing and the Fed was tightening, or vice versa. So if conditions are different in the two countries, and it means the Fed may have further to tighten and the bank is easing, that's what happens, and that's fine. Now, are the conditions such that you could see that with the Fed rates going up and the bank rates coming down? And the answer is yes. I'm not sure that that's the central case in terms of the forecast. But what's happening in the U.S. is you're getting this big boom in productivity that's raising potential growth, that's allowing the economy to expand significantly while still keeping a lid on inflation. Productivity, as the senior deputy governor actually gave a great speech on this a couple of weeks ago, couldn't be more different in Canada. Productivity is contracting, as the bank acknowledged in its report this morning. And so the only real impetus you're getting is the people side, and then that's going away. And so what is actually going to sustain the economy if you don't get productivity and you have fewer people? It's got to be easier policy. So you could get this divergence going ahead. The other point maybe I'd make is, as you know, I used to be at the Bank of Canada. I'm no longer, so I don't have to give policy advice, and I'm perfectly fine with that. My job these days is managing the funds at Fidelity, and particularly running the asset allocation part of it. So what's really important is not so much that divergence in policy, but the implications of that divergence for asset markets. And one of the pretty clear implications, and we're seeing that in the market action this morning, is if U.S. rates need to be firmer and Canadian rates need to be lower, Canadian dollar is going to go down. And we've been positioned that way. It's been helpful to the performance of the funds, and we're seeing more of that today.
I want to talk a little bit more about investment strategy in this environment. Just on rates specifically, we're kind of dancing around the issue, but I think a lot of Canadians just want to know what is going to happen with interest rates. What is your best guess at this point?
You know what? I'd love to know that too. And to be frank, the bank would love to know that too, because they're not just being coy about saying, I know the governor was asked a couple of different times, would you cut rates in June? And he's not just being coy about saying, well, we'll see, and it's live and what have you. He genuinely doesn't know. None of them do, because it depends on how conditions evolve. I have my expectations, so do they, but we're going to have to see. But I think what I would take from the bank's comments and their forecasts this morning is they do expect rates to come down, and potentially significantly over the next year or two. Exactly when remains to be seen, but that, to my mind, and I used to be on the side that actually produced these forecasts, that's got to be in there.
And I guess on inflation itself, how should we think about this inflation blob, monster, whatever it is, which has, been characterized so many different ways over the last couple of years? We're looking at a chart for our audience from Stats Canada, just over the last, call it almost 15 years, really, of what's been happening. And, everybody knows we go into this pandemic, and then supply chains are quiet. They have to get back to business. You see this explosion in prices. We wonder if it's transitory. Then there's like a fresh conversation around there's some fundamental changes in what happens with prices. And, I think a lot of people are still betting on this idea that we'll have lingering inflationary pressures for years to come. So how do we tackle a subject like inflation? How should we think about it going forward?
Well, so that's probably a whole show in and of itself in terms of, as you said, it's a blob, and it's got a lot of different, I'm not sure what the metaphor is for a blob. And, but what I would say is, so as you mentioned, inflation shot up in the pandemic. There were demand reasons for that. There were supply reasons for that. Now we're seeing a normalization in both sides, but inflation is remaining sticky. So some of the interesting analysis, I think, that was sort of buried in the monetary policy report today is the bank has done a lot of research on pricing behavior. So not just inflation up, inflation down, but how often and how commonly firms are changing their prices. And that is coming down somewhat, but it's still on the elevated side. And I think what's happening, and we've gotten a lot of good information from our fleet of equity and fixed income analysts within my firm, who are actually talking to the companies and thinking about their behavior and hearing about what these companies are actually doing. I think the way to think about it is, for 20 years, it was sort of not cool to raise prices. Right? You had competition, you had price stability, so you really just couldn't get away with doing that. And what changed in the pandemic is you had the cost pressures, but also people were accepting of those price increases in a way that they hadn't been for decades. And once that genie leaves the bottle, it's hard to get it back in. So, it's not like, it's okay to raise prices again. People may not want to either the companies or individuals, et cetera, but it's not, a no-go the way it was for so long. So to the extent to which it's hard to get that genie back in the bottle, it also means that getting inflation all the way back down to where we had it for so long is going to be a long process too.
I went to buy a pack of gum this week, and they put in the wrong price, but I was ready to accept this astronomical price for gum, maybe because we're all living through this inflation experiment. David, good points. We're going to take a quick break. We're going to come back with David Wolf and talk a little bit more about portfolio strategy, talked a little bit about how to think about currency in this environment. We'll be right back with more here on Morning Markets.